With market valuations at multi-decade highs, a war in Iran threatening oil supplies, and incoming tariffs dominating headlines, your anxiety is completely justified. That anxiety naturally leads to a centuries-old instinct: sell in May and go away. Moving your portfolio to cash for the summer feels like the safest way to protect what you have. This chart maps a $1,000 investment from 1976 to 2025. Following the sell in May strategy, your balance reaches $46,000 today, but the buy and hold investor sits at $295,000. Leaving the market historically destroys your capital. Seasonal trading rules simply do not apply to 2026. We are looking at a market driven by hyperscale capital expenditures, an additional $125 billion, fueling 4 consecutive quarters of double-digit earnings growth. Retreating to cash based on the calendar is a fast track to underperformance. Survival this year requires targeted exposure, not total retreat. However, staying passively invested in broad index funds like the S&P 500 leaves you heavily exposed to localized bubbles, particularly as a handful of companies now dominate the benchmark. Instead of fleeing to cash, the strategy rotates capital into 4 specific American asset classes. First, U.S. equities focused on the AI ecosystem, and U.S. fixed income, locking in peak yield corporate bonds. Then, targeted commercial real estate, and finally, short-duration money market funds. These 4 pillars serve entirely different functions. Aligning your capital with your specific risk profile determines your outcome. To utilize U.S. equities, you are allocating capital directly into high-valuation tech enablers and financials. The goal is capturing a slice of the $725 billion in AI capital expenditures projected for this year. Tech leadership is accelerating the deployment of data centers and custom chips, preparing for a total spend of nearly $750 billion. Software innovators aren't the only ones profiting. Utilities are seeing increased demand to power these servers, and industrials are fulfilling the backlog for physical infrastructure. You have to contrast this growth with severe value traps. Traditional sectors, like low-end consumer discretionary goods, are deteriorating rapidly under tariff pressures and a softening consumer base. Committing to this asset requires the psychological stomach to tolerate severe volatility as market expectations ratchet higher. U.S. equities offer the highest potential reward this year, but they demand extreme selectivity to survive an increasingly narrow market. Our second asset, commercial real estate, requires committing illiquid capital into private funds or specialized REITs. The objective is securing defensive income by entering the market right after private property values bottomed out in late 2024. This grid maps U.S. cities against asset types, separating preferred markets from those to avoid. The primary risk is capital destruction. If you buy into oversupplied multifamily units in places like Austin or grocery-anchored retail, aggressive underwriting will wipe out your returns. Commercial real estate is a geographic and sector minefield. You can only generate a return by relying on hyper-local data. Our third asset is U.S. fixed income. This involves locking capital into 3 to 7-year high-quality corporate and municipal bond ladders, a space known as the belly of the curve. You are doing this to secure peak income yields right now, before the Federal Reserve cuts rates toward 3% by year-end. The primary trade-off is inflation. If trade tariffs cause an unexpected spike in consumer prices, the real purchasing power of these locked-in yields will erode. Locking into the belly of the curve guarantees your income stream, but you permanently sacrifice liquidity if macroeconomic inflation returns. Finally, we have U.S. dollar money market funds, which simply means parking highly liquid cash in short-duration instruments. Investors use this to achieve zero principal risk while harvesting 4 to 5% yields, acting as a buffer against geopolitical shocks. This chart displays global fund inflows, with nearly $700 billion currently parked in U.S. money market funds. But hiding in cash creates reinvestment risk. Look at the equity allocations. When the Fed cuts rates, those yields vanish, leaving you with zero growth. Money market funds are a temporary shield, not a permanent strategy. If you overstay, you will be forced to buy back into the equities market at a steep premium. To figure out where your money belongs, look at this scenario match matrix. We use this to permanently map those 4 assets against specific investor profiles. First is the optimizer. This is an active, high-conviction investor willing to do deep sector research. The optimizer requires an overweight allocation in equities and niche commercial real estate while strictly avoiding money market funds, so every dollar stays working. Next is the accumulator, someone with a long-term horizon who prefers a heavily passive approach. The accumulator needs a steady, balanced blend of financial and tech equities paired with high-quality corporate bonds. For both of these growth profiles, suffering cash drag from money market funds or trying to sell in May destroys your ability to compound wealth over time. Our final profile is the yield seeker. This is a highly defensive investor, likely near retirement, who prioritizes income over capital growth. They require heavy fixed income to lock in current rates, keeping only a 10 to 15% allocation in money market funds purely as a volatility buffer. Yield seekers must strictly avoid commercial real estate, unless it is a highly specialized medical net lease property. Looking at this completed matrix, you can see that a perfectly constructed portfolio for one profile is toxic to another. The greatest risk to your wealth in 2026 isn't a market crash. The real danger is holding the wrong asset when macroeconomic conditions pivot. Identify your specific profile, select your targeted asset, and permanently ignore the calendar.